presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compac YouTube update for March 3rd, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. Don't forget to subscribe to this channel. Just click on the link on your screen, and whenever I post an update, you'll be notified so you can watch it at your convenience. Let's start with the numbers. Market was down nearly 1% last week for the S&P 500. The Dow was higher by 1%. So that is overall a good thing, but not as good. NASDAQ was down 3.45%. And as you know, I don't like to see the NASDAQ. I like to see the NASDAQ leading to the upside and the S&P second and the Dow following. We're in the opposite, where the Dow is leading, then the S&P and the NASDAQ. So I think the markets are getting a little bit nervous overall, and I'll talk about that in a little bit of detail. Last week, financials were the best sector as interest rates plummeted as the uncertainty increases. Are we going to get the tariffs imposed on Mexico and Canada tomorrow? 25% tariffs are announced that they will go into effect tomorrow. If they do, it will cause, the expectation is that it will cause inflationary pressure on prices. How much inflation that will cause, we don't know yet, and the markets do not like uncertainty. Also, there's a lot of uncertainty in the geopolitical events out there. So all of this combined with the economy, the numbers we're getting showing that the economy is slowing. With that, there's quite a bit of nervousness in the market, and technically we're starting to roll over a little bit, and I'll talk about that also in a little bit of more detail right now. Looking at the oil market, down quite a bit, nearly $2 a barrel last week. As the economy slowed, the demand for energy goes down globally, and with that demand going down, we're seeing downward pressure on the market. Also, we're seeing the gold market down. The big news last week was interest rates. They dropped from 4.42 down to 4.24. That was a big, nearly 20 basis point drop in rates. As the economy slows, the demand for credit goes down, and the expectation is that the Fed will have to step in sooner or later to bring rates down as the economy slows. So that is putting downward pressure on rates, and rates going down, as we said, as long as they're between 4.5, it's okay. But if they start getting much below 4, then what the bond market will be telling us that the bond market is expecting a slowing economy. As the economy slows and prices go up, that would not be a good recipe, because if prices go up, it sort of handcuffs the Fed for lowering interest rates and supporting the economy. But as the economy slows, the Fed has got to lower interest rates to add more liquidity to the system. So that will be a push and pull depending on what the economic policies are out of Washington. How much should we get in tariffs? What are the tariffs that are going to be placed on Europe? Are they going to place tariffs on us? What is China going to do? So all of this is creating a lot of uncertainty in the markets. The government also is cutting spending, which is, I believe, a good thing overall, because there's a tremendous amount of waste. There will be things that will be done that they'll point out, oh, this person was fired because it was terrible, and there will be mistakes that will be made when there's such a big change in government. But overall, cutting government spending is going to be positive, because also the markets are very nervous about the new budget that is being proposed. Is it going to increase the deficits, where the government will have to borrow, or the government, the U.S. country as a whole, will have to borrow about $4 trillion. That's $4 trillion if all the budget cuts and all the tax decreases, tax cuts go into effect. So that will cause also the government borrowing that could push rates up quite a bit. So there's all this uncertainty that is causing a lot of nervousness in the market. We're seeing the consumer spending fell by 0.5%. Inflation was just about at the core level, just about as expected. So that was not a big deal. We did see the ISM numbers came out. slightly less than expected on the ISM index, but it's still above 50, came in at 50.05, so that is still expanding. Anything above 50 is showing that the economy is still growing overall. The big number will be private payrolls, will be unemployment numbers coming out on Friday. Expected non-farm payroll is around 160,000 jobs created. We'll have to wait and see, because last month's number was very weak at 143. If it continues to go, the number of jobs created starts to go down. That also will show that the economy is slowing. But the labor market, you have to remember, is the last thing that goes down. If the labor market is going down, that means the economy has already slowed. That's what the expectation is. Looking at the rates, looking at the markets, the red line is the 50-day moving average. We've broken below that last week. The blue line is the 50-day moving average. Red line is the 20-day. Blue line is the 50-day. That's 59, nearly 6,000, 59.95, and we're 59.09 this morning. So the market is starting to roll over. Also, we're starting to see a fifth wave, even though the target for the fifth wave is somewhere around here, around 62 to 62.5 to 6,300. It seems like as long as we get a higher high above 3, that satisfies the fifth wave. Once we see wave 5, that means that we are either going to see an A, B, which is back up, C, pullback in the market, or we start 5 waves to the downside, like this fifth wave top that we saw last July. And from there, we had a pullback going into August. That was an ABC correction. Here's the A, B, and C down here. And that's what happens once we get the fifth wave top. And that's what seems to have happened here. More importantly is the weekly charts that I've talked about for the last year and a half or so. You look at the weekly chart, this blue line is the 50, the red line is the 20-week moving average. We broke below it in October of 2023, right here. We got below it right here. And then from there, we came and touched it a few times, got below it one time, but closed above it, touched it here, but now it seems like we have broken below this. Next support is right around here, which would make this a fourth wave pullback, taking us down to about 56.5 to about 5,700, somewhere around there. And that would be a nice sizable pullback in the market from the high that we saw around 6150 to 6200. So that pullback, I think we are starting to see this. Also, on the weekly charts, we're starting to see, but that could last. Fourth waves are usually messy, could last for a few months. And if the tariffs go into effect tomorrow, I think it could have some more negative impact. And if we get an unemployment number that shows weakness also, that could also have a negative impact on the market. So overall, looks like we're in for a pullback here in the markets from a technical perspective. NASDAQ also came down to the 200-day moving average last week, kissed it, bounced off of it, but now we're coming back towards it, which is 18,369. We're at about 18,600 this morning. I would not be surprised to see the NASDAQ even headed a little bit and bounce around here for a period of time, or even headed a little bit lower. Why do I say that? Each one of these vertical lines, the green and red lines, is 1 day of trading. But if you go to a weekly chart where each one of these weekly lines is 1 week of trading, you can see this dots that I put out here. And when they're above the market, above these vertical lines, then the market is in a downtrend. Usually when these dots, they usually last 6, 7, 8 weeks when the dots get above the market. When they're below the market is trending nicely higher. You can see last week, the dots flipped and the market has turned negative now. So 18,000 would not surprise me at all for the NASDAQ. We're at 18,600 today, down from about 20,000. So markets seem to be quite a bit in a nervous state, feel like we're going to get some more pullback here until we get some clarification on tariffs, until we get some more clarification on the budget, until we get some more clarification on the economy. And until that, markets are going to stay, I believe, in a state of flux with a downward bias overall. Interest rates also are telling us the same thing. We gapped down last week, broke, this is a huge gap on the markets, broke below the 200-day yield, which is around 2.23. Today we are 2.18. So that is also interest rates going down means the economy is slowing and people are buying bonds. When they buy bonds, interest rates go down and the price of bonds go up. That's why having the right combinations of bonds and stocks in your portfolio, when stocks go down, bonds go up, and to sort of keep it the declines in check in your portfolio. And that's why having the balanced portfolio, having the right degree of risk reward or the risk balance in your portfolio is critical. And that's what in the long term pays off. Having all tech stocks is not, it pays off when the markets are going up, but it also hurts tremendously when the markets go down. Everybody say, well, I'll get out before the market goes down and I'll go back in with. That's a fool's errand most of the time, as we know. Picking tops and bottoms, as you've heard me say for 30 years, can be hazardous to your wealth. There should be a little sign that there is on the side of cigarettes that smoking can be hazardous to your health. Picking tops and bottoms can be hazardous to your wealth. So don't try to do that. Have the right risk. If you don't have the right risk, give us a call. We'll be more than happy to help. Find out what you're trying to accomplish with your financial picture. Where are you headed? And how do you get there? So we get you on the path that is the least bumpy, that is the least rocky. Going up and down like a yo-yo is just emotionally, it's tiring, and it is not what will get you there in the long term. And that's why we try to build portfolios that will stand the ups and downs of the market. Small caps also breaking to the downside, where we saw, again, we are starting a wave count to the downside, wave 1, 2, now we're in wave 3. Looks like we're headed towards 200 for the IWM, which is the small cap ETF. Crude oil also breaking to the downside, as when it got to about $80 a barrel, I said I thought it was overdone. Now we're getting close to that support area. There's a good support right around here, which is around $67 a barrel. And this morning, we were at 67.89, and we're trading right now at 68.29. Gold also starting to break to the downside. Looks like we've made a fifth wave top on that. Also, next support is around 2,800, then about 2,600. We are trading around 2,900 this morning in the gold market. Those are my views. Those are my thoughts right now. So again, if you don't have the right risk in your portfolio, you're feeling uncomfortable with your portfolio, give us a call. We'll be more than happy to help. You can send an email to invest@compact.com. We'll get back to you. We'll sit down with you. We'll develop a plan for you. All of that is free. Or you can just give us a call at 800-388-9700. 800-388-9700. Thank you for joining me today. I'm Mo Ansari. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.